Oh boy, what a day. Dan Frio here, the Mortgage Update. And we want to go over what happened today. What happened when the Federal Reserve came out and reduced rates by 1/4%? I'll tell you what happened on my end. The phone went crazy because everybody thought, or everybody's thinking is, well, mortgage rates just went down 0.25. That's not the case. So I want to do a little educational session right now, but I want to kind of show you what happened in today's market. I'm going to give you some scenarios on, maybe a better way to explain this for you. So today, you see 0.6 up. That's good, but it's not enough to really change interest rates. You need about a 0.8, a 0.10, 12, something like that to really make an effect on rates. You'll see throughout the day it was down. So, it was down throughout the whole day. There really was no action in the market. Look today, basically, virtually flat to a point. You can see it right here, 0.6. Okay. So why didn't, when the Federal Reserve dropped rates 1/4%, why didn't rates go down? Okay. That's a great question. And most people don't know this. All right. Here's what happens is, the Federal Reserve controls a key factor in the banking business or banking world. It's called the federal funds rate. And that's the money that banks are charged for overnight lending. That's it. Okay? So, however, that factor, that number has a kind of a ripple effect through the industry. So it will affect the discount rate. It will affect the prime rate. It just happens to correlate with all those numbers. Okay, so let's get on to the Fed and mortgage rates. So here's what I want you to do. This probably is the best analogy or the best information I can give you right now. Google mortgage-backed securities. This explains what it is. This is actually, if you go back to here, where'd it go? Let me make an adjustment here. If you go back to here, you see how this is MBS? That is this. So what this is the mechanism that directly affects or dictates mortgage rates. And it's basically their bonds. They're a batch of bonds or mortgage-backed securities that are traded on the market daily. So rates fluctuate every day from 10 in the morning or 9 in the morning to 4 o'clock in the afternoon. So this will explain to you what that is. Basically, they bundle up a whole bunch of mortgages. They sell them off as bonds. The bondholders get a return. They pay X for the bonds. So let's talk about that for a second. They pay to get into these bonds. They pay to buy these bonds. Okay, so I always say the price of the bond is what we're monitoring here. This is the price of the bond. So this bond price went up 6 basis points. Thus, the higher you pay, the more money you pay for the bond, the lower the interest rate. So there's an inverse correlation there, or an inverse relationship. As you pay more for the bond, that makes the yield of that bond come down because you're paying a higher price for that bond. And again, this won't be an economic lesson. I won't bore you to death with that. But go to mortgage-backed securities and just read through this. It's intriguing. Watch the video. It explains to you exactly what that is. So no, it is not when the Federal Reserve comes in and says we drop rates 1/4, it doesn't affect mortgage rates. Here's what happened. So the best analogy, and I think I made this yesterday, is let's say you're watching a stock, and let's say that stock is Google. Okay, Google comes out and says, next quarter, our earnings are going to be great. In the background, that's the Federal Reserve coming in and saying, next meeting, we're going to drop rates. Okay, so keep that in mind, those two things. So when Google announced that they're going to have record earnings, what happens? The stock doesn't just sit there. The stock runs up in value. Okay, let's go back to the Fed. The Fed announced saying they're going to reduce rates the next meeting. What happens? Same thing. What happens is mortgage rates or interest rates start to drop because of that. The federal funds rate didn't drop. They're saying they're going to drop that federal funds rate, but again, everything else it has a trickle effect off of that. So instantaneously, when they announced that, mortgage rates started to come down. That's why you saw interest rates on mortgages go down about 3-4 weeks ago. And everybody was like, hey, I noticed mortgage rates went down. Well, the Federal Reserve didn't reduce rates at that time. They just said they were going to. So keep that in mind. Remember that. Going back. Well, rates just dropped dramatically a month ago. Well, the Federal Reserve didn't come out with anything or say they didn't do anything. They just said something. Okay? So now let's forward fast. Now, Google, it's the day of their earnings. And they come out and say, you know what, we come out, here's our earnings, and they did blow out the door. Okay, what happens to their stock? Nothing. It's already priced in. Okay, thus, when the Federal Reserve comes out, as they did today, and said, we're dropping rates 0.25%, as they said they were going to do, what happened in the market? Nothing. Okay, where the focus is the verbiage of what they now say, their forecasts. So Google comes out and says a couple things. One, next quarter's even going to be worse. Thus, it would be like the Fed saying, at our next meeting, we're going to reduce rates more. So what would happen in that scenario? Well, Google stock would run. Conversely, when the Fed said that, mortgage rates would drop again. Okay, so that's one scenario. The second scenario is they come out and say really nothing. They're like, well, we don't really know what we're going to do in the second quarter. There's no guidance there. So what do? Don't know. We don't have a clue what we're going to do. The third thing is they can say, this is basically a one and done. We reduced rates, but that's good enough, and there's nothing else from there we're going to do. Rates would have went up. So it's like Google coming back and saying, we don't really see any quarters going forward being that great. So what's going to happen? Their stock's going to start to drop. That's the best correlation I can make on what's going on right now. So here's what happened today. The stock market went down 500 at one point. It ended down like 333. So what happened is the person who speaks for the Fed came out and they made all the news was good. Inflation numbers were good. They said the global economy is kind of slowing. That's not good for the global economy, but that's good for interest rates. And then the person said that they answered a question. And here's what he said. He said, well, this is like we're considering this a mid-cycle adjustment. And everybody's like, whoa, what's that mean? So basically, the interpretation was basically back to that scenario I said on the Google stock, saying we hit our quarterly, results and it was phenomenal, but going forward, things will just be mediocre. So the market went into turmoil. So they're like, what's going on? Then as he spoke even further, we think somebody kicked him under the table saying, dude, what are you doing? He came back and said, you know what, we're going to track this on a daily basis, and we're going to do what's needed to make sure the economy doesn't suffer. So that kind of put things at ease a little bit, thinking, okay, well, if things start to get a little worse, they're sitting there right on the button to say, we're going to drop rates again to help spur the economy. That's my best analogy to this. So as you can see, nothing happened today. Here's basically the trend of what happened. Nothing. These are days where things moved. Right here. So nothing really happened today. So sometimes I had a couple of clients call me and say, does that mean I have a better rate? And I said, no, but really nothing happened today. And a lot of them probably think I'm pulling their leg. And that's why, I do this. Again, what do I do different? I educate you. I keep you informed. I monitor the market for you. And that's what I consider, that's my job. That's what I'm hired to do. That's my job. If you just use a loan officer that just, click, click, click and does their thing and just goes through it, with stamping a piece of paper, moving it on, that's not me. So if you want that, God bless you. If you want somebody to really work with you, and again, the costs to me are, I'm cheaper than, all the other companies out there. I got probably the most competitive rates in the market. Why not use all this expertise? So if I can be of any help, please let me know. I got an 800 number. You can reach me. It's 877-5loan, or even a better way to reach me is dfrio, Frio, at parksidelending.com. Or if you want to get an application started, just go to themortgageupdate.net. Remember the .net, not .com. So themortgageupdate.net, you can click the apply now button. You might get some of my assistants or some other of the loan officers on there with me. But please just click out my name so it comes directly to me. I'll probably be in contact with you within an hour or two to kind of go over that information, make sure it's accurate. So make sure we put you in the right program and get you into the best scenario possible. So again, I greatly appreciate you watching this. Please don't forget to give me a thumbs up if you would. Click the subscribe button down there. Also, click share. Share this with everybody else that's out there, especially if you're a realtor, financial planner, a mortgage person. Spread the word. I'm going to try to post this the best I can daily, and kind of go from there. So if I can be any help, please reach out. Take care. God bless. Have a great night. See you tomorrow.